Okay, good morning, everybody. So as Simon mentioned, I am going to look at the overall macro environment that we're operating within, looking at it from an economic perspective and looking at some of the larger kind of sociological trends that are impacting on us now and likely to impact as well over the coming few years. So the first slide that's up on your screen there just looks at the total UK economy, and I know that for a lot of people who are in the audience, it may not feel quite like this quite now, but overall for the economy as a whole, the outlook in the short term is looking quite favourable. And this is driven by the successful vaccine program, which has been rolling out since December last year, and is recognised throughout the world as as a real success story. The success of the vaccine program rollout has enabled the economy to start to reopen, and as a result, that has led to a huge rise up in business and consumer confidence, both of which are critical to improvements in the state of the economy. Confidence in consumers, confidence in businesses always ends up driving strong performance in the economy. So what are the economists expecting? What are they forecasting over the next 12 to 24 months? In 2021, we're expecting somewhere between 6.5% and 7% growth, and in 2022 that drops just by a small amount to somewhere between 5% and 5.5%. Now, both of those that's much stronger growth than the UK economy has experienced for quite some time, over 30 years. Part of it is driven by the fact that we're comparing against a weak year in 2020, but then and therefore the economy is growing in 2021, but it's off a low position, should we say. And then we'll obviously see the economy then settling back down to more normalized levels of growth, somewhere between 2% and 3% is the expectation in 2023 onwards. So what's driving this? Well, if you look at the charts on the right-hand side of the slide here, the green lines that sit below the zero line relate to the drag on the economy, and the drag is coming from net trade. So that is the differences between imports and exports, and we'll come on to it in a moment, but we're expecting imports to grow at a sort of healthy rate driven by consumption. However, exports are declining, and that's as the kind of the UK economy adjusts to the post-Brexit environment, and no one's quite sure where that's going to pan out on a long-term basis, but we do expect UK exports to be down. However, the flip side, what's driving all the growth? So in 2021, you can see the majority of the growth is coming from three areas really. The yellow bar represents business investment. The government recently announced in their budget a number of incentives to get businesses investing again after quite a period in the last 12 months where business investment has been held back. Most notably, the accelerated capital allowances. So up until now, if you invested £200,000 or less into plant and machinery, you got accelerated capital allowances, but that threshold has been increased up to £1 million. So to drive inward investment that has been held back. So there's an expectation of quite a bit of investment being made by businesses to benefit from some serious tax reductions. The next area, the light blue line in the growth chart of 2021 relates to government consumption, government spend, driving growth in the economy. Excuse me. And right now we are seeing a huge amount of government spend, in particular healthcare, education, and that is driving, growth in the economy, in GDP growth throughout the UK economy. Clearly, we expect that as all of the different schemes that the government and support schemes, etc., that are out there, as those start to decline over and get switched off in 2022, government consumption returns to a more normalized kind of level of spend. And then the final point, which we'll go into in a bit more detail, is household consumption. So household consumption typically drives the majority of GDP in any year, and we are looking to a return to growth certainly in the second half of 2021, and then strong growth into 2022. So on to the next slide. What is driving the growth in household consumption? Well, at the start of the pandemic, what we saw was households cut back massively on the spend on services, while on the whole maintaining spend on goods. As you can see from the narrative on the left-hand side, overall spend on services dropped by £120 billion in 2020. Some of that reduction was reinvested by households into services, and into goods, excuse me. So we did see a small amount, but overall household spend dropped by a significant amount during 2020. However, what happened to household income? Household income actually stayed reasonably flat throughout 2020, as a large part as a result of the furlough scheme, which maintained incomes for employees throughout the UK, which meant that household income remained flat while their expenditure reduced. And as a result, you can see from the chart on the right-hand side here that that household savings increased significantly above the historic trend rate for the last few years. It's estimated that there's potentially up to about 170 billion of excess savings so far built up into the economy. And the expectation is that as restrictions start to get lifted, that this excess savings that will be invested back into the economy, and that there is pent-up demand, consumer demand, that will go back in. So that's good news, and that is a key driver of economic growth over the next kind of 18 months. On to the next slide. What the downside risk? So what are the risks to this forecast? Well, most economists agree that the key downside risk is the impact of new COVID variants. I mean, clearly at the moment, vaccines are doing a good job against different variants. However, what happens if a variant hits that the vaccines have less impact on, and are less resistant to, and nobody knows the answer to that, and God forbid, hopefully we don't see that, but should we be impacted like that, then the chances are we will have to go into additional lockdowns, and there will be a consequential impact on the economy as a result of that. But the good news, or if there's some good news in there, the good news is that we saw in the most recent lockdown that a lot of businesses have learned to adjust and to trade and continue even at a lower level, but they have learned to continue operating during lockdown periods. So the impact would not be as great as we saw during the first lockdown, but we would definitely still see some sort of impact. A second risk that a lot of the commentators agree on is around insolvencies. You can see from the chart on the right-hand side here, this is the number of insolvencies on an annual basis over the last 20 years or so. And we saw during the 2008, post-2008 financial crisis, a huge spike in insolvencies. And unlike that crisis, we've actually seen a decline in insolvencies, and the reason for that is that the government put in lots of measures to limit the insolvency processes, restrict the insolvency processes, to protect businesses throughout this period. And actually, for the last 12 months, insolvencies have been running around about 25% down on their pre-COVID levels. Compared to the last financial crisis, they're running almost 50% down. And you would, as a result of that, there are going to be businesses that would have gone out of business over the last 12 months under normal operating circumstances, and those businesses have been protected and have continued to operate. And so there is no doubt some sort of pent up distress in the economy within certain businesses, and that's likely to have also been made worse by the crisis. So I think the general view is that when these restrictions are lifted, which is expected at the back end of September at the moment, when these are lifted, we are going to see a rush of insolvencies. However, we have no idea, what level. Could it be worse than the 2008 crisis? Will it be, better? We just don't know. But that is clearly a large potential risk as well to the overall forecast. As we saw in the last lockdown, January through to March, businesses overall have learned to cope and trade and continue, far better than they did back during the first lockdown, where all of us, largely shut up shop and we were looking at, very, very low levels of output. Yes, we saw a decline in output during the fourth lockdown, the third lockdown, can't keep up with it, January through to March, but not as bad as we saw the previous March. So that is, one risk. Another risk, business insolvencies. The chart here on the right-hand side shows on the very, very right-hand side of the chart, you can see the level of business insolvencies over the last kind of, 6 to 12 months. And they've been running, about 25%, if not more, below the normalized level of run rate over the preceding 5, 6, 7 years. And this has been because of the government. The government changed the rules, and they've protected business throughout this period, from general insolvency legislation. And at some point, and that some point is rapidly drawing near because it's the end of September, those rules are going to start to normalize and go back to where we were previously. So the protection that businesses have faced will be lifted. Now, you would expect, therefore, that a number of businesses that would have normally gone into an insolvency over the last 12 months anyway, regardless of COVID, and those businesses have been protected. In addition, there are businesses who, have borrowed, a huge amount of money to get through the last 12 months, and unfortunately are not going to be in a position to repay those. So there are different levels of predictions, but whatever happens, overall, most people are expecting quite a bounce back in insolvencies later in the sort of the final quarter of this year and the first quarter of 2022. And really, it's where does that level hit? And as you can see, back in the last financial crisis, 2008-9, there was a huge spike in insolvencies. Then we haven't seen that. So are we going to catch up with that? Could it be worse than that? I don't know. But again, something for us all to think about across our customer base, that our customers have been protected from this for some time, and what's going to happen going forward. Clearly, credit risk for everyone. Next slide, please. So the overall economic recovery, then, we just talked about, we're looking at, somewhere between more than 6% growth in this year, and sort of somewhere around 5 to 6% growth in 2022. But it's going to be uneven across different sectors. So we're not expecting every single sector to recover. And you can see here, looking at the different areas of the economy, different sectors have definitely been impacted in very, very different ways over the last 12 months. And the recovery, therefore, is also expected to be very, very different. And once again, I'm sure, everybody in this room will know through talking to your customers, etc., those businesses that have been hugely impacted. Manufacturing and construction. So on the left-hand side of this slide, probably the least impacted as a sector throughout this whole period. They saw, roughly a 40% drop during the first lockdown, but a very quick recovery. And then the restrictions that most other sectors of the economy have continued to face have been less applicable to the manufacturing and construction sectors that were allowed to continue operating during subsequent lockdown periods. And back in March, only 10% of jobs in these sectors were on furlough, which was significantly below the kind of 18% average furlough rate across the rest of the economy. So they're almost getting back to sort of normal levels of operating. Retail and personal services. So when we're talking about personal services here, it's all the the hairdressers, a lot of the high street sort of activities that you see that everyone is participating in. Retail actually is has been the best performing sector. Again, going back to what we talked about with household spend. Spend on goods has remained relatively flat throughout this period. It's spend on services that's been most impacted. So as you can see here, retail has pretty much, apart from the first lockdown, actually been performing above pre-COVID levels, and is expected to do so over the next kind of 12 months or so. Spend on other personal services has been massively impacted, and you can see it almost correlates directly to the lockdowns that we've seen, and is bouncing back very strongly at the moment. So that area of the economy really is bouncing back at the moment and has picked right up as the high streets have reopened. And then finally, those poor people operating in hospitality, and in particular the aviation industry. Hospitality, and aviation clearly were completely closed almost throughout this period. Hospitality saw a small bounce back last summer. Eat Out to Help Out scheme, people staying in the UK in particular last summer did help to drive a bounce back in this. But then as soon as we went back into lockdown again, and restaurants, bars, hotels, nightclubs, etc., all shut back down again. And the aviation industry pretty much closed at the beginning in March last year, and essentially hasn't reopened since. Talking about my trips before moving, before the pandemic, there used to be about 18 EasyJet flights a day between Geneva and the UK. When I was looking for a flight over here, there were 2 a week. And that's just EasyJet, let alone all the other airlines that fly between Geneva and the UK. So that is symptomatic of the amount of traffic. And business travel is not expected to recover for years, if ever. And we'll come on to that a little bit later. So next slide, looking then at the recovery on a regional basis, linked very much back to what I was just talking about then. As a result of the recovery of different sectors of the economy, different regions specialize much more. So, everybody knows it. The south and southeast of the UK are very service orientated, where the north, sort of generalizing here, but the north is much more manufacturing. And fortunately, this time around, it means that the north has actually seen a stronger recovery than the south, and the south is still lagging behind in terms of recovery, the overall economy. Now, as the restrictions are easing at the moment, the south is expected to open up again a lot more quickly and is expected to recover. But I know, we're going to come on to talk about it later as well. The south is a very office-based environment, and there's a lot of kind of worry, anxiety, concern about office reopening at the moment, and that is taking longer than we'd all hoped, and therefore is having a huge impact on our industry, but also regionally the UK. So from a regional perspective, if we move on to the next slide, this is an opportunity now, for the government to really drive the levelling up agenda that it announced, particularly at the last elections in 2019, where the government specifically said that they were going to look to, level up the UK economy. And that was a ticket that, got Boris Johnson into number 10. So, this will be the real test as to whether he does deliver on that. The Chancellor announced free ports as well, the introduction of a load of free ports, many of which are located in the north of England, to really drive in investment, inward investment, set up essentially the free ports are kind of tax havens within the UK borders. And so there's all sorts of advantages and benefits to businesses located inside those free port regions. The Chancellor's hoping, obviously, that will drive, inward investment, and in particular, a lot of some, or well, not all, but some of the Brexit restrictions that we now face. Those free ports are kind of slightly isolated from them because they operate outside some of the normal barriers. But really, to make the whole levelling up agenda a real success, Simon talked earlier on about people's willingness to change and how that would impact. Well, a key driver of whether we're going to see a sort of a levelling up across the UK will be people's willingness to change, because it is going to be a real, we're going to need to change a huge amount within different regions to enable them to grow. And investment is not just going to have to be in business, it's going to have to be skills, it's going to have to be some of the social amenities that are offered, etc. So it doesn't just require investment into business. It definitely requires a look at holistic approach. Next one. So I'm now going to just cover some of the sort of key economic indicators. So rather than looking at a sort of top level of the economy as a whole, this is some of the sort of drivers of overall performance. So the labour market, and something that hugely impacts on our industry. The more people that are working, essentially, the more businesses are spending on consumables, and therefore the impact on our business. So the labour market has actually been pretty resilient over the last 12 months, but the main reason for that is the furlough scheme, so the coronavirus job retention scheme. At its peak, back in the first lockdown, nearly a third of private sector employees were on furlough. That was getting on for 9 million employees. In May, the average number of employees still on furlough was 3 million. That's 12% now of private sector jobs. So there's still a huge number of people on furlough. It's nothing like it was at its peak, but it is still a lot. And as I talked about when we were looking at different sectors of the economy, not unsurprisingly, back in May, that was mainly in the hospitality and distribution sectors. So the real question mark that everyone has now is what is going to happen when the furlough scheme eventually comes to an end, which, as far as we're aware, is going to be in September. How many of those jobs are at risk, and how many will go back into employment? And the general consensus seems to be that at least 90% of people on furlough today will fortunately return to work. Unfortunately for the 10%, so we are talking around about 300,000 jobs, but for that 10%, that is likely to lead to a spike in unemployment, and most pundits, commentators, are expecting unemployment to peak in the final kind of quarter of this calendar year, and we could see it peaking at around about somewhere between 5.5% and 6%, and that is compared to where it was, it's actually still relatively low. So compared to where it was after the last financial crisis, still relatively low, which shows the sort of overall strength. We are looking very much, overall at a V-shaped kind of recovery here. I know it's kind of bounced back and forward over the last, but it was a deep recession in 2020 with a quick recovery out in 2021, and then a solid growth into 2022. As long as that happens, then we are looking at relatively low levels of unemployment, which is great news. So the next measure, and one that is really impacting right now today on us and on our sector, and is very much being you asking me to pause?
And then I've got a quick question, actually. So if anyone does have I've got a question, which is that do you think the furlough scheme is going to end?
Yes.
You think it is? Okay. All right. Okay. You think there's no risk? Well, I said risk. There's no opportunity for the government to extend it, given the whatever wave we're in. But
no. So I think the key risk, as I mentioned, the key risk to the forecast is what happens if another variant hits the UK, and it's a variant that we don't know what it might, how it might work with vaccines and things like that. That is the big unknown to all of this. If a variant comes that happens to be have a worse impact on people that have been vaccinated. Fortunately, the Delta variant, the vaccines, are working against, and as a result, it's not having a huge impact. And as a result, we can continue to kind of open the economy at the moment, thank God. But what would happen if a variant hits that the vaccines don't work so effectively against? In that instance, if we do have to go back into more lockdowns, then sure, the furlough scheme, as we've just talked about, the furlough scheme has been a huge success. It's cost the government a lot of money, but without it, it would have cost the government a hell of a lot more money.
Okay.
So it has been a resounding
Can I
success.
just ask another question on that? There is a shortage of labour at the moment, right? Particularly in the supply chain, so it's been a success. But there's a shortage of labour, which is disrupting businesses, both hospitality and I think kind of distribution or transport are the two key areas I'm reading. So is that another reason why it's unlikely to be extended? Because there is rumouring that it might be extended.
Yeah, if you want my opinion on that, I think that the bulk of the jobs that are still being furloughed at the moment, where we're seeing shortages in labour, it's actually being driven more by the availability or the easy access to labour that we had, particularly seasonal labour coming out of the EU, and we don't have so much access to that labour anymore. So we have seen a sort of net decline in people working in agriculture, hospitality, and a lot of that was very seasonal labour that kind of migrated around the EU where the work was at particular times of the year. So that I think is causing the biggest issue there. If we then put the furlough scheme back in place, would that help that problem? I don't think so.
Okay, thanks.
Yeah, so the next measure, inflation. This is in the press constantly at the moment. Everyone in the room is no doubt feeling it. I know there are some suppliers in the room at the moment, and you're constantly talking to those of us that are distributors about price increases, and I'm sure your suppliers are also seeing those increases. There has been clearly we're seeing cost pressures driving that up. There's also all of the tax cuts that have happened over the last kind of 12, 18 months or so that are driving up. The general view is that these are short term. It's while the economy is kind of adjusting post, in particular, that first lockdown. And as a result of that, the view is that inflation will come back down again below the 2% target. It's been running, you know, a lot lower for the last 12 months. And the other point is that there is still, you know, quite a bit of capacity in the economy, and therefore, you know, if we were nudging right up against the capacity levels, then that would push on a long-term basis, push prices up. However, we're not. There is still capacity, and therefore, hopefully, the Bank of England will continue to kind of hold interest rates at their historic low levels. So the next slide, what is it that's actually currently driving prices up? The first area that we're seeing prices really drive up and is oil. As we went into the first lockdown, oil prices, there was actually, you know, an excess of supply of oil for about a 2 to 3 month period. And at one point, oil companies were actually paying customers to take oil off them. It was that kind of, it was that bad. So oil prices absolutely tanked, and oil prices, you know, feed through to road fuel prices, and obviously energy prices, etc., and some commodity prices where oil is a component. But in particular, you know, it's road fuel, so distribution and energy costs that really dropped last year. They've now risen again, and they've risen just to more normalized kind of levels. But obviously, we're comparing, inflation always compares year on year. So we're comparing against a historic low level now to a more normalized kind of level of energy prices. But that is driving inflation. But we would expect oil prices to continue to run at the kind of level that they're at the moment, unless, you know, the oil producers start to constrain supplies. But you'd expect them to run at that kind of level, and therefore this should sort of balance itself out. The next area, commodity supply chain. This is the one that we're really feeling at the moment. The first lockdown in particular just set the whole global supply chain out. It just knocked it for six, basically. We've seen there was and as we're growing back out again, that increase in demand, there is basically an excess of demand over the supply of goods. So we're seeing knock-on impacts in terms of shortages of products. That's driving up commodity prices. It's driving up supply chain, you know, movement prices, distribution, etc. You know, driven by this kind of spike in demand that we're seeing. And at the start of this year, well, you know, at the end of the first quarter, prices had already risen by about 10%. A small amount of that was Brexit related, but a lot of it was driven just by the global supply chain and global cost price increases that we've seen. Once again, these are expected to settle back down again. So, you know, it's rare that you see prices, you know, particularly product prices kind of drop. But the overall expectation is that we should start to see prices drop again in probably 2022, but unlikely during the remainder of this year, because it is going to take at least 6 months for the overall global demand levels and the supply chains to kind of settle down and recover. And as we saw right at the start of the presentation, there is still strong, you know, we're expecting strong global demand for consumption, which will continue to put pressure on the availability of product. And then finally, we mentioned it, the hospitality sector at the moment is benefiting from low levels of VAT, 5%, which was dropped back in at the beginning of the pandemic, I think, or it might have been for July time when the hospitality sector started to reopen. And that low level of VAT is going to start increasing. I think it's in September. It goes up to about 12.5%, and then it returns back to the normal standard rate of 20% in March next year. So increasing the prices in the hospitality sector will drive up inflation. And also Eat Out to Help Out scheme, which some people say was a huge success. Other people say, wasn't. Depends what side of the fence you sit on. But it did drop prices back in August last year, July, August time last year. And clearly we're going to see, that we're not going to have the Eat Out to Help Out scheme this year. So that will be a one-off that drives up inflation through August. So, these are not inflationary pressures that are kind of long-term impacts. These are just a one-off as things settle back down again, but is going to have a short-term impact on inflation. Tied to inflation is obviously interest rates. There's been a huge amount of borrowing over the last 12 months. Businesses have borrowed a huge amount. Households less so, as we talked about. The government has borrowed an enormous amount. We'll come on to that in a minute. So what do we think is going to happen to interest rates? Well, I think, the overall view is that interest rates, certainly in the short term, are likely to remain relatively flat, as opposed to being raised to combat inflation. As just described, the view is that this inflationary pressure is temporary. It's while the global economy kind of realigns itself, and therefore we're not going to be raising interest rates to address something that is just a temporary measure. So the general view is that certainly in the short term, for the next kind of year to 2 years, interest rates are likely to be held at the low levels that they're at, because the impact on the overall economy of raising interest rates could be far more detrimental than there's some positive impacts it could have addressing inflation. Exchange rates, not a lot to say here. Again, they've remained relatively stable over the last 12 months. All currencies have been kind of flowing in a similar kind of way against each other, and as a result, exchange rates are just relative to other currencies. Sterling has strengthened a bit, up to 5% over the 2021 year. So, relative to other countries, sterling has performed slightly better, but no sort of sharp shocks. And again, it's forecast, we're forecasting relative exchange rate stability going forward, now that we kind of got through the Brexit bit that added a lot of volatility. So final point really just looks at government borrowing, and this is the sort of the summary of everything. And government borrowing rocketed in 2020. The government, I think the total costs of all of the COVID schemes that the government has undertaken is about 350 billion. And the government has had to borrow a large amount of that. Government was borrowing 14% of GDP in 2020. That's the highest level since the war, the Second World War. So, we're talking, huge levels. But based on what I've just talked about, after the last financial crisis in 2008, it took roughly 5 years for the level of government borrowing to halve. That's not expected to be the case this time, because we're looking at such a V-shaped recovery. So the level of borrowing is expected to come down very sharply as the government starts to turn off all of these schemes, which they're doing, right now and over the next few months, all the support that they've been pumping in. But overall debt now is now over 100% of GDP. And again, we haven't seen that level of borrowing for, I think it's about 70, 80 years or so, since the 1930s. And the government's been able to do this because of the low levels of interest rates. And what that means is, that we are looking at a potential sort of, the government is facing a real risk there. And that's the kind of the juggling act that the Bank of England is facing, because increases in interest rates, well, as you just put down there, you may or may not be able to see it, but a 1% increase in interest rates will cost the government 12 billion in interest. So, which will have put a huge dent in that kind of budget figure that we looked at right at the start, and the overall progress. And as announced in the government budget recently, part of the recovery and the reduction in the borrowing is going to be funded through switching off the funding that they've been putting into the country. But then the other part of it is going to be through increase in taxes. And we're looking at higher corporation tax coming in 23 that will affect all of us. We're looking, going to be looking at 25% corporation tax, which is a significant increase. There's capping of income tax, personal income tax thresholds, etc. So these are all the areas that are going to start to repay back the debt over the next 12 months. And obviously, that huge demand in consumer spend will turn into receipts in terms of VAT and etc. So that's it kind of on the economic indicators, really. Overall, relatively positive kind of outlook for the economy as a whole, but different impact on different sectors and some risks that, as ever, that we're talking about. Now I'm going to quickly trot through. We've identified 10 sort of key macro global trends that are already impacting in 2021 and likely to impact, for the next few years. And these are non-sector specific, but they clearly, a lot of them will impact all of us in one way, shape or form. So the first one of these was the huge acceleration in the fourth industrial revolution. The fourth industrial revolution is basically automation. So the third industrial revolution was all about the digitalization, so personal computing, the sort of the latter end of the 20th century, personal computing, digitization of archives, all that kind of stuff. And pre-pandemic, for the start of the 21st century, we've seen a slow move towards automation. However, the start of the first lockdown saw an enormous acceleration in that, where businesses were forced to automate tasks that previously were being undertaken by employees, because those employees couldn't come to work, couldn't access, et cetera, et cetera. You just take a very simple one that's relevant to all of us. Just the signing of documents. If you signed stuff for the bank, it had to be done, with a pen, handed in. That's now been turned around. Banks, lawyers, etc., will all accept. You can sign stuff on DocuSign, which previously most places wouldn't accept that. And this is at a very simple level, processes that have been automated in the last 12 months or so. And the real impact of that is on productivity, and it's kind of like, what impact will it have on productivity? Who knows? But certainly, in taking the US as an example, that's the only area that I've got that. We've seen the highest increases in productivity in the second half of 2020 for nearly for 50 years basically. So it is, we think, that it's going to be, this will have a real driver, and obviously will impact, our businesses. What are we all doing to automate, and what are our customers doing to automate, and what will that mean for demand? Secondly, the recovery, it really feels like finally there is an awakening to the cost of damaging the environment and the benefits of sustainability. And unlike in the last financial crisis, all the government packages that were put together, very, very few of them focused on the environment, on driving a recovery through addressing some of the environmental issues. However, this time it definitely seems different. Big proportions of government money that's been pledged to recovery across the world has been pledged to environmental green projects. And I know I can speak for our business. We're definitely sort of seeing it in demand for some of the products that customers are requesting. That's on a small scale, but on bigger scales, the energy, electric vehicles. There's been the biggest growth of electric vehicles ever over the last 12 months, and expected to continue to push. And the sums of money that are being put behind this are incredible. So the green revolution really is here and is likely to stay, and is something that we should all be aware of, because a lot of money is being pumped into that sector. The next one, please. So now, again, another sort of key one that we've all seen. This has impacted, I'm sure, everyone in the room from a personal perspective. The traditional consumer shopping habits, the behaviors of all of us have basically been turned on their head overnight. When we went into lockdown, and everything, we could no longer just go to the high street to pick up whatever it was that we needed. Suddenly we had to source through alternative means. The statistics here, in 70% of developed nations, 2/3 of consumers said that they have changed their buying behavior at some point over the last kind of 12 months. And then in 100% of developed nations, 2/3 say that they intend to continue doing that. So this is not, just a sort of one-off as we dipped in, and then come back out again, that consumers did it because they had to. Consumers have now embraced new ways of purchasing, and are likely to continue to do that. And that will massively impact, anyone selling products who doesn't address this and doesn't consider it. It's definitely going to impact them. The UK, which has incredibly high internet penetration, online retail for sort of on a global basis, hit an all-time high of 36% online retail sales mix in February this year. And to put that into perspective, pre-pandemic, the UK was running at around about 18% online retail sales mix. So again, an enormous increase. I think we covered about 10 years worth of where we expect it to be in that period of time. It will drop back a bit, but certainly it's going to impact, and what people do in their personal lives will impact their business lives. That people are used to that online purchasing experience now. Supply chains, we talked about this a little bit earlier. The impacts of supply chains, we all know it. Everybody has been, through the 1980s, 70s, 80s. So everything moved offshore. Everyone moved to cheaper production environments, predominantly in the Far East. And we've all lived for the past 30, 40 years with kind of cheap imports coming into our environment, and a lot of us have benefited from that, and the global economy has definitely benefited from it. However, as suddenly when those supply chains were disrupted, everyone started kind of looking in the mirrors and going, oh, do we need these global supply chains, or should we be looking at a slightly different? And in particular, 3 observations came out of those businesses looking at their global supply chains that may mean we see a shift going forward. The first one being that most people, when they looked at their supply chains, suddenly realized that actually disruption isn't so unusual. Most companies would expect to shut down for at least a month every 3 to 4 years as a result of some sort of disruption in their supply chain. Now, admittedly, the shutdown that we had last March, April time was extreme, but most people always have this level, whether it be because of fires in a factory, illness, unscheduled maintenance, etc., etc. Everyone expects this. So really, this kind of shock isn't so unpredictable, and therefore everyone should just be managing this as a normal risk. Secondly, The cost differential between developed and developing countries has narrowed, enormously over the last kind of 20 years. Costs in developing countries have increased. It's no longer quite so cost effective, and in particular with some of the more recent distribution costs, we're definitely seeing that it's not as cost effective to source offshore. And then finally, our understanding of some of the lower levels of the supply chains as business people is relatively low. So we have a good understanding of who we're buying from, and we understand their business often. However, we don't necessarily understand their suppliers and who they are and what impacts their business, and therefore how the supply chain all links together. Now, I'm definitely not saying that everybody's suddenly going to onshore all of their production, because I don't think that will happen. But I definitely think that over the next few years we will see some rebalancing. We will see a lot more production coming maybe closer to home into Eastern Europe and places like that. And I know from talking to you guys, some of you guys in the room, that you're already doing some of this. So that's happening. Ernst & Young there predict that potentially up to 25% of exports could move around the globe over the next kind of 4 years or so. So that's a huge number. Then one that everyone is familiar with, the kind of the working from home trend. The working from home trend, pre-pandemic was moving at a very, very slow rate. And overnight at the beginning of the first lockdown, millions and millions of people moved to a home working environment. And what will happen on an ongoing basis, we don't know. I know, I'm sure there are very, very different views, and we're going to talk about this later within the room as to the positives and negatives of home working. But potentially around about 20% of the global workforce could work from home on an ongoing basis. They have the possibility of doing that. And not everybody will, but what percentage of those people will continue to do this? And this, as you put there, this is a sort of once in a lifetime kind of shift in working practice that we've seen happen overnight, and will in some way, shape or form, to what extent we don't know, but will continue going forward. Next one. The hangover. Again, this links back to the economy, government debt levels that we talked about. Governments across the world, there's the statistic, $10 trillion have been pumped into the economies by G20 countries, and the majority of that money has been borrowed, and that money has to be repaid back. And how that money is repaid back is going to massively impact the economy, our lives, the society as a whole over the next probably 10 to 15 years. The different schools of thoughts for economists, do you raise taxes? Do you cut spending? Do you drive growth and productivity, etc.? There are different approaches. I think the UK government is taking a combination of both. We're expecting, growth to drive a lot of the reduction in debt, but there's also, as we talked about, the raising of taxes, which is going to impact all of us. But governments clearly don't want to raise taxes too much, because that could also, A, slow down the recovery, but B, impacts on political kind of popularity and therefore impacts them. Next, healthcare. Healthcare systems as a whole tend to change very, very slowly, but we've seen, a big shift in healthcare systems and the healthcare environment over the last 12 months. And I think, sadly, the sort of underinvestment that an awful lot of developed economies saw, the underinvestment in their healthcare systems from the last 20, 30 years really was spotlighted, highlighted over the last kind of 12 months in terms of the cost on lives and livelihoods, etc. And we have an opportunity now, to really address this. And some countries are really tackling this, others aren't. But we could see a huge, again, generational shift in healthcare systems and how healthcare is delivered. And again, from a business perspective, we also are likely to have to address this in terms of, ensuring that we've got healthier work environments for our employees, that we invest into our employee health, we redesign the workspaces, et cetera, et cetera. So it's not just about the healthcare supplied by the government. It's about how we as a nation, as a society, kind of tackle healthcare. This one, so portfolio adjustments. Essentially, every time an economy goes into some sort of decline, into some sort of crisis, you see a big shakeup of business and sort of corporate portfolios, and really. What tends to happen is it tends to push businesses to either extremities. So back to what we were talking about, the sort of uneven impact. The pandemic really has had an uneven impact across industry and then within industry as well. And what it turns out is, not unexpectedly, but strong businesses tend to come out of financial crisis even stronger, while weak businesses tend to get weaker or go bust. And the difference between those businesses is general sort of corporate resilience. And what this means is that those, one of the ways that this is delivered, and we're seeing it 100% in our industry right now, that take, for example, the balance sheet strength of businesses. So that corporate resilience, businesses that had strong balance sheets previously are likely to have even stronger balance sheets now relative to their competitors. And they're now using that balance sheet strength to go about building through M&A, picking up distressed businesses, picking up businesses at lower valuations, etc. So, corporate M&A activity, I think, will definitely continue. It will accelerate, and there's huge amounts of values of private equity out there at the moment, sloshing around. $1.5 trillion is supposedly sitting as what's known as dry powder in these private equity funds that will be used to drive this portfolio restructuring. So expect to see more change going on. Penultimate one, a little bit fluffy, but it is definitely going to impact us. And I think, most of you, particularly businesses that have got sort of smaller local businesses, will hopefully have started to see some of the benefit of this. But stakeholder capitalism. So in essence, this is the belief that businesses are not just there to serve the benefit of shareholders. Businesses exist to serve society, customers, employees, etc. And this is a view that's been around for a long time. Despite the fact that this view's been around for a long time, the success that we've seen of the free market economy and the benefits that has had on the global economy, there is still a huge distrust of businesses. In general, that is a huge generalization, but it is true that there is a distrust. And what the last 12 months has kind of thrown out is that link, that bridge between business and society, and in particular local businesses, local, that link, and therefore, I think there is a huge opportunity, a real opportunity for businesses to sell off their values, and to as it says there at the bottom point, to kind of blend profit with purpose, and actually that will drive greater profits in the long term. So this is more of a long-term view, but people have started to wake up, rather like the sort of the green revolution that I think in general people were behind, but government wasn't necessarily behind. This is something that people, society wanted, but business wasn't necessarily waking up to so much. And now we are really starting to see business waking up to the benefits of looking at that wider stakeholder base. And then finally, the biopharma revolution. Now, I'm definitely not going to pretend to be an expert in this area, but the COVID vaccine development is the greatest example of this. And what we've seen over the last 12 months is unbelievable. And had you said, 18 months ago that we will develop from scratch a vaccine that will be rolled out on a global basis within a space of 12 months, everyone would have said you're absolutely mad. It's absolutely impossible. But as a result of a load of different capabilities, like combining, working together, whether that be the regulatory environment, engineers, AI, data analysis, sequencing, etc. All of these activities came together to enable a rapid rollout of the vaccine. There's obviously a huge potential use for this within the pharmaceuticals environment. And if we applied the same level of learning and momentum that we had, then clearly in the pharmaceuticals environment, we could accelerate some of the drugs to tackle some of the world's worst illnesses. However, I hadn't really thought this through previously, but there are a huge number of other applications of this bio revolution, using biochemistry, bioengineering, etc. I read somewhere that up to 60% of the physical inputs to the global economy could be manufactured biologically. And here are just some examples. And I thought these were just fascinating because suddenly it just opened my eyes to all of this. So take in the agricultural space, we could genetically modify crops to be drought resistant, thereby making agriculture more efficient, thereby getting food to economies that so far struggle where they may have famine impacts, etc. So improving global lifespan, etc. Energy. We could engineer microbes to create biofuels, thereby replacing, traditional fuels like oil, etc., etc. In the material space, self-repairing fabrics because they're working all the time, using different types of silk to make strong materials to work with, etc. So, as I say, we could manufacture through a biological process as opposed to a traditional manufacturing process a huge amount of products. And what we've seen over the last 12 months with a whole load of these processes coming together is that actually we can accelerate this. Unfortunately, the UK is a global leader in this kind of environment. So, we, along with kind of the US, we are kind of at the forefront of this revolution. So, again, customers of yours, businesses, we're likely to see real development in that kind of area.